Since the end of the last financial crisis in 2008, there has always been concern about a threat of inflation from the amount of new money that has been created. And after years of quantitative easing and trillions of new dollars created, the long-awaited inflation is finally here. However, it is also coming at a time where global economy is facing an uncertain future. So instead of a gradual, slow landing that the government hoped to engineer, it seems that we are in for a violent crash. But all that volatility is also making us more confused about the market and how we should be positioning our portfolio. You might feel that the market is far from the bottom and we are heading for another deep crisis soon. You might be also feeling maybe the opposite, that the market is cheap now and present an opportunity of a lifetime for you. Yet, we cannot be sure, can we? The truth is that we can sit here and argue whether it's time to sell or buy our stocks in our portfolio. But doing that will mean that we fall into the trap of trying to time the market. And that will be a game that we always lose. This is because that even if we make the right call this time around, it is merely just round one. And going forward, we will have to start guessing about where the market is going again and again and again and again. The more decision we make about market timing, the more mistake we end up making. But the good thing is that if you're working and adding more saving into your portfolio, your cash position is building up naturally. So if you have a long investment time frame, say for example, you're investing for the next decade, then you might not need to worry so much about the next short-term crash. This is because, statistically speaking, a downturn in the stock market typically takes about 2 to 3 years to recover. So instead of trying to time the market, if you can afford it, it might be just safer and easier to just ride it out. However, if you do not have the luxury of time, say for example, if you are already retired or you're relying on your portfolio as your main source of income, then having a way to insure your portfolio might make sense. This is especially true if your portfolio makes up of the majority part of your whole investment and wealth. Holding on through a crisis in the next 5 years might be a major setback for you if you need to start living off the portfolio. So if that's the case for you, how can you reduce the risk of facing an even greater crash going forward? Well, I think here are some ways that we can buy an insurance policy for your portfolio. Option 1, short the S&P 500. Since you're protecting against the market crash, a more direct way might be just to go ahead and short the S&P 500. You can either really go out and short some of the more common S&P 500 ETF. A short is basically borrowing stocks from your broker and selling them in hopes to buy them at a cheaper price later on. Shorting is available through some brokerage, but it will also involve some additional costs for you. Some of the more common S&P 500 ETF are the Spider S&P 500 ETF, the iShare Core S&P 500 ETF, or the Vanguard S&P 500 ETF. But bear in mind, in effect, you are betting against some of the largest and best company in the US market. And that might not sound as wise as I put it in the context, but if you are able to size it correctly, you might be able to add some negative correlation to your portfolio. This means that if your portfolio starts to decline, this short position might offset some of the losses. And in essence, that is an insurance policy. Option 2, buy inverse S&P 500 ETF. Another option for you is to just buy an inverse S&P 500 ETF. So rather than shorting the ETF directly, this other ETF would help short the index for you. A more common inverse S&P 500 ETF are the ProShare Short S&P 500, the ProShare Ultra Short, or the ProShare Ultra Pro Short. Some of these ETF even provides additional leverage by tracking 2 or 3 times the return of S&P 500 index. So if you read through the prospectus of some of these instruments, it can be quite tedious as they are mostly synthetic ETF. This means that they are not really going out to short the ETF, but just using derivative to simulate that effect. But to our point of view, the impact is the same. Basically, if the market falls, we will profit. But bear in mind, there will be some cost involved as well. Option 3, long the VIX index. The VIX index is an index tracking the volatility of the market. It is a key index investors use to gauge how much fear there are in the market. So during times of crisis, the VIX index tends to increase significantly. We cannot technically buy the VIX index as there's no underlying entity to it, but there are ways to mimic that return. There are some exchange traded notes or ETN, such as the Barclays VXX or VXZ, that will try to mimic the return by buying VIX futures. The problem with futures is that they have what we call time value. This means that the longer the time to their expiry, the more expensive they tend to be. In other words, their value will decay over time. And this is quite a terrible problem to have because time never stops. So for example, if the time decay costs about 2% a month, that's roughly 24% a year. In fact, I'll be taking a loan at 24% a year in hope that the stock market will crash even more. Well, this doesn't really sound very appealing to me, but if you're planning to do it for just a very short period of time, maybe this could be a possibility. Well, if not, you can think about option 4, buying put options on the S&P 500. Another way to buy insurance in the stock market, it comes in the form of put option. A put option is the option to sell a certain underlying asset based on a predetermined price. So basically, if I buy a put option to the S&P 500 at a strike price equal to maybe the current price, I would be buying an option to sell the index at a predetermined strike price, even if it declines in value in the future. But like futures, there will be costs for you when buying this option, and you have to decide if that cost is worthwhile. Well, lastly, you can also sell all your shares. Last but not least, if you're worried, you can definitely sell your shares, keep them in cash, and rebuild it when you see fit. But this option can become complicated and time-consuming if you have a large portfolio. Well, so you see, there's no real perfect solution to it, just like there's no real perfect insurance policy for us. Being exposed to the volatility of the stock market is just part and parcel of being an investor. And at the end of the day, all of the above options are just ways that we can create kind of an insurance policy for our portfolio. But there are always costs to it, and we need to weigh if the costs justify our needs. And similar to buying an insurance, we should always have just a small portion of that capital allocated to this. After all, it's about protection, not about maximizing return. So what are your thoughts on this? Will you buy insurance to your portfolio? And if yes, which would it be? If you have gotten value from this video, please give us a like and share it with a friend who you might think will benefit from it as well. And of course, you can always go to our website, valueinvestasia.com, to find out more about us. Anyway, my name is Stanley. Till we meet again, invest safely.